Good afternoon, everybody. This is Mike Fielding. I'm a partner in the Husch Blackwell Food and Agribusiness Unit. I want to welcome you to our webinar today. This is a quarterly webinar that we have been doing, dealing with a variety of financial issues relating to food and agribusiness. Today, we are in loan renewal season, farm loan renewal season, so we're going to be talking about minimizing agricultural loan and distress. That's where I focus my practice, representing lenders dealing with distressed ag and commercial loans. Joining me today as well is Stephanie Kaiser. Stephanie is from works predominantly out of our Austin, Texas office, and her practice is just like mine, focusing on helping lenders dealing with distressed ag and commercial loans as well. So we hope that today's presentation is helpful and insightful. What we're going to do here, I have a few housekeeping matters. I'm going to read over this and then we'll get into the meat of the program. At the bottom of your audience console, there are multiple application icons for use during the program today. If you have any questions during the webcast, please submit them via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or if we run out of time, we will respond to you later via email. A PDF presentation is available in the resource folder. The program has been approved for legal education hours, and to report your hours, you will need to click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. And just as a side note, if you have teenage kids and you want to put them at sleep at night, I'm sure this may do. At least I know that would work with my kids. So continuing on, toward the end of the program, be sure to complete our short survey. We use the feedback to plan future programs that are applicable to your business needs. We really do appreciate comments that we get in that regard because you do get helpful insight from you, the audience. The one last item is we will have some poll questions coming up during the presentation. Some states require that to get CLE credit. We've designed these poll questions so that you can get, frankly, a feel for what the audience generally is viewing about distressed agricultural loans, and so we hope that you can respond to those when they come up. So without further ado, let me get going with today's agenda. You can see it up there on the screen, the 6 different items that we are going to be covering. And to split things up, we're going to have Stephanie cover the first 3 items, and then I'm going to cover items 4, 5, and 6. So with that, Stephanie, I'll let you run with the ball here.
Good afternoon, everyone, and thank you for joining us today. So the section 1 is very common to a lot of us in this industry. We're going to be at various points in a loan career looking at distressed loans or deteriorating debts. And especially, as Michael said, during this time of the year where we have stop points, what I call stop sign opportunities, to stop and look at a credit and see where we are as we're renewing that loan or looking at it for other evaluations. So for me, gosh, I've been practicing law 21 going on 22 years. And during the last economic downturn, I spent a lot of time just looking at debts and helping classify debts from an interior perspective and from a legal perspective as well, meaning both from a loan review or credit perspective as well as a legal perspective, and then going from there. So a lot of this that I see is mostly from a vantage point that I have from a very practical as well as a legal perspective, representing folks in the farm credit industry as well as commercial banking, community state banks, and credit unions. A lot of the definitions I apply are very universal, but where they tend to be particularized, I'll try to point that out. But generally speaking, there is kind of this universal definition of a distressed loan that we'll kind of work from today. And it can vary somewhat, but generally speaking, you're going to have this concept of does the borrower lack the financial capacity to pay the loan according to its terms, its then current terms. And then after that, if you decided yes, the borrower does lack the financial capacity to pay the loan according to its current terms, then we're going to look at, are there one or both of the following elements present? One is the borrower demonstrating adverse financial and repayment trends? And I always emphasize the word and, because both of those elements do need to be present under many definitions of distress. And the second aspect is the loan delinquent or past due under the terms of the loan contract, that existing loan contract. And the regs here are focused on to a concept of inadequate collateralization that also can kind of come into play from time to time. I'll talk about that as we kind of get through some of the other concepts we'll discuss today. But generally speaking, you've got this key definition: lack of financial capacity coupled with one or both of those two elements that I mentioned really help give us kind of some background on what is a distressed loan. And there are opportunities when something looks like a distressed loan, but it just doesn't meet that definition. So when I peel back that first element, which really to me is the gatekeeper element, what is that borrower's financial capacity to pay? What does that mean? So for at least me, some of the things that I found were helpful include some considerations like, is the borrower delinquent under the terms of the loan contract with the lender? Or are they in default on other covenants like taxes or insurance or repairs? Have they experienced any adverse changes in their employment, cash flow, their assets, or their liabilities? Has something happened on their credit picture or their operation picture that we need to stop and look at? Again, not fully indicative, not dispositive of any one of these aspects, but just something to stop and see, is there something going on that we should further analyze? And of course, for me, whenever we look at a loan and someone calls me up and says, Stephanie, I think I've got this loan, want to make sure we properly classified it, what do we do? I always pull out the definition applicable to that particular person who's calling, whether it be the regulatory definition, where I'm always going to start, coupled with if I have their internal guidance to make sure I've put those things together and said, let's break out the elements and make sure we've analyzed it the way that we need to. Because I think it is important, just because you have a stop sign moment where you have a change in the operation, a change in their performance under the loan, a change in their financial assets, something that's different about them than was before, doesn't mean necessarily it's distress. It's just an opportunity to evaluate. And sometimes it could be a default rather than a distress. So in looking at that, what does it mean to be distressed and how can we distinguish that from a default? So the borrower's repayment of financial history can be part of that picture. And so I always ask myself, what is that borrower's repayment of financial history with the lender and with other creditors, not just us? Because that first element, that gatekeeper element of financial capacity, generally, in my experience, it's measured by the performance of that borrower under the existing loan contract, that financial capacity to pay. And that's limited to that particular lender's loan with that particular borrower more often than not. But the other elements may not be so limited, especially the adverse financial and repayment history. So looking at that, I'm going to look at, is that borrower current with us, but are they in default with other creditors in one or more ways? Is the borrower current with us but cutting corners? For example, collateral maintenance issues, delaying payments. I'm looking at their aging of their payables and their receivables. Are there differences there that make sense to us? And do we understand if there are any differences, why there are those differences? Is that borrower relying upon one-time events to remain current or to stay afloat in certain respects? Are they picking their mortgage debt to keep current, but then pushing other debts around or restructuring those debts? Are they current with us? And I use the word current. I'm going to come back to that word in just a minute. Is that borrower current with us, but a default is expected? Like we know that there's a seasonal event coming up. There's an industry-related event or a market-related event that we're aware of that could impact them in their portfolio, or our portfolio, I should say. Is there a weather-related event that we should be sensitive to? Has the whole area been geographically impacted in some way that we should be mindful of and look at? Is there collateral at risk? Remember that element of that definition we looked at earlier from 12 CFR 617-7000, where it basically said, either one of those elements coupled with inadequate collateralization can represent a risk to the lender. This is part of that analysis. So I'm looking at, what does the collateral look like? Let's say they're making all their payments, but the collateral is suffering, or it's at risk of what? Conversion, theft, default, disposition to pay other creditors, perhaps out of trust with that particular lender. Several of these things could be a default under the loan contract or set of documents you have with that borrower, but a loan may not be indicative of distress. They're all just opportunities for us to stop and analyze those elements we've talked about so far. So I have never called them the 3Ds, but for now, given how they're written on this screen, I'm going to call them the 3Ds: the delinquency, deterioration, and distress. These things can be very similar. They can go hand in hand, but they really can be distinguishable at the same time as well. So as we've kind of talked about here, a loan can be delinquent, which to me means a monetary default, meaning they haven't paid their installment. They're not current on their installment. So I mentioned that I would focus on that word for just a second. A lot of times I'll have lenders tell me, oh, they're current under their loan. And when I say, go ahead and send me their repayment history, I love to get those repayment histories, and frankly, I'm sure a lot of you do in this presentation as well. get that repayment history, and I look at when are the installments or when are the payments due or expected versus when do we actually receive them. And not only that, I think that side-by-side column analysis for me has been critically important. It can be done in a matter of minutes to give me either one, yes, there are aberrations, or two, there are no aberrations, there are no adverse, at least repayment trends from a timing perspective. But then I go peel back and say, what are the sources of those payments? But nevertheless, I mentioned the word current. So meaning if they're current with us, that truly means they've paid on time. They've paid not only their installments if there are scheduled installments, but they've also paid their real estate taxes if that's part of the loan requirements that they have with you as a lending group, for example. Are they current on their real estate taxes? Are they current on their insurance premiums? If those are monetary terms under their loan, that to me is part of the are they current question. So a loan can be delinquent or in monetary default without being distressed. But I think it's always important to look at that financial capacity, again, as the gatekeeper analysis. So let's say someone doesn't, meaning they have the financial capacity to pay the loan according to its terms, but they're just not paying. They just don't pay. They're withholding back their cash, or they're holding it and saving it for another event. You know, if that happens, let's say someone is late on their payments with you, they are delinquent, but they're not distressed. Sometimes I've seen people rush to go ahead and send out some notices of like a distressed loan or a distressed classification in their credit write-ups or their loan narratives. And why do they do that? I think a lot of time in my experience, I see it with folks who don't know what else to do. They want to make sure they're evidencing to the regulator or to the reviewer that they're doing something, they're analyzing that credit. But really, we want to make sure that our credit documentation is always accurate and it always reflects that we're doing not just something, but the right thing. And while partial credit, meaning documentation, is always critical, and I think you do get partial credit for documenting your thought process, even if someone disagrees with you, so it is important to document. If you don't know what to do, if you've written down your elements in your loan write-up, and you said, gosh, you know, they do have the financial capacity to pay the loan according to its terms, they're just not paying, so they're delinquent, what do? There's a few things you can immediately do and make sure it makes sense given your loan structure and given where you are in your internal guidance. But you could be sending out a payment reminder notice, and maybe it's appropriate that you send out a default notice, even in advance of a distress loan notice or whatever might be required under your guidance or regulations. There is something you could be doing just to make sure, and when all else fails, pick up the telephone and have that conversation and say, we've noticed some differences, can we sit down and talk about those with you? Very important set of aspects to consider, just to be doing something. And so whatever we do, we always want to document why we've done the thing that we've decided to do. So if we have determined, kind of a little bit different, that the borrower's financial position is deteriorating, but let's say we're not fully in the bucket of they lack the financial capacity to pay the loan according to its terms, or we've made that determination, but one or both of those other elements aren't yet fully present, then at the very least, at least in my experience, and again, take your internal guidance at your lending institution into account, document that, you know, they lack the financial capacity to pay, but they are not yet demonstrating adverse financial and repayment trends, or they are not delinquent at this time. However, here's what I think is helpful, to go ahead and document, we are going to reach out to the borrower to do X, Y, or Z, and then do that thing. Or we are going to go ahead and pull some additional information. We're going to schedule an inspection. We're going to schedule an assembly of collateral. We're going to visit with the borrower. We're going to gather additional external data like real estate taxes. We're going to do something else to see where are we and why are we here, and maybe put it on a watch. I always like to document, we're going to continue to monitor this and do in fact monitor it, and then do a reminder system that works for you and your internal group. But either way, just document what you're doing and properly identify that loan status, and whether that's sending out a notice of distress, whether that's sending out a notice of default, sending out a payment reminder notice, gathering data and monitoring it, but documenting what you're doing and, of course, holding yourself accountable to that timeline. Really, really critical in my experience, and it goes very far in terms of making sure you handle that credit appropriately. So if a loan is deteriorating but doesn't truly satisfy that definition, of course, I always think, and we'll be talking about this in just a little bit, but as a precursor, I think it's important to keep a timeline, at least for my purposes. I find it helpful to keep a timeline in mind. I keep a 90-day clock running in my head at all times when I'm looking at credits, and I'm looking at credits that we're trying to properly classify given where they are at that time. And for those of you who might not understand why I say 90 days, we'll talk about it a little bit more, but for present purposes, I'll say there is something called the non-accrual debt and a non-accrual debt classification. And so generally speaking, the 90 days means something and can help identify when a loan has become non-accrual or has gone non-accrual. We'll talk about that. There's more elements to consider. But the reason why that 90 days is important is not just to make sure you've regulatorily checked a non-accrual box. It's definitely more than that. In my experience, what it also means is that you've looked at the debt. You know that if a loan goes non-accrual, there's additional cost to maintain that loan. It also could mean that the borrower has gone down further in the deterioration, further in the distress, and restructuring that loan or returning it to viability can become more problematic, especially in the agricultural sector. So you want to identify it as early as you can, whatever's going on in that credit, whether it's performing and it's great and you get to move forward, it's deteriorating and you're going to monitor it, or it's distressed and you're going to make sure you capture the next steps that you need to be capturing as soon as possible in a 90-day clock to keep the hole that the debt may, or that the credit may be experiencing as small as possible for an enhancement of likelihood of success. In my experience, and I've done a lot of these loans for a really long time, the longer you wait, the less likely it is that you can actually return that loan to viability. So we've mentioned here that there is something called a non-accrual debt. If you ever really look at a distressed loan definition that applies to your particular lending sector, and you compare that on the other side to the definition of non-accrual debt, and then take a third comparison and put in what does it take to reinstate a non-accrual debt to an accruing debt or a performing status debt. If you look at all of those, the factors and the elements really go hand in hand, and they also couple very nicely with the 5 C's of credit in various ways. So here, and of course, you'll all get these materials afterwards, and I won't read them, but I'll summarize that I think it's important to realize that there is an interrelationship between a distressed loan, a non-accrual loan, and of course, reinstatement factors that we want to be consistent in our analysis of. So as we kind of indicated here, a loan may or may not be past due, but let's say we've determined that the collection of the outstanding principal and interest plus future interest accruals over the full term is not expected because of a documented deterioration. And so we want to make sure we've documented that and make sure, do we think that we're going to have any dates about that collectability? We also are looking at that 90-day mark, like I was talking about earlier, making sure that we realize that the loan is 90 days or more past due, and they're not otherwise eligible for classification of a loan that is past due but accruing interest. And of course, legal action, has that been initiated to collect the outstanding principal and interest and debt? Making sure all of those things are, of course, identified properly, whether it's a non-accrual debt, a TDR, a troubled debt restructure, or otherwise, and of course, documenting it in accordance with your internal guidance. So whenever we have these classifications, of course, there are internal classifications, reporting requirements that come along with these classifications. Definitely have those here so you can read those at your own leisure back at your shop. But I do just want to keep in mind when I say the 90-day clock, this is what I'm talking about, because again, in my experience, the longer a loan remains in deterioration, even if you haven't fully gotten comfortable that it's distressed, do take action. Don't wait until it becomes from one risk rating to a lower risk rating because you don't know what to do. Do see what you can do sooner rather than later to modify the loan, to re-amortize the loan, to see what actions can be taken to help keep that loan and that hole surrounding that loan as small as absolutely possible, assuming it's not a performing loan. So some signs of distress are kind of included here. We have delinquencies on installments, taxes, and insurance we were talking about earlier, those dispositions outside of the ordinary course or operational cycles that we've experienced with that borrower. We've had external forces like downturns in commodity prices. We've got those family or personal issues. There's death, there's divorces, there's tax liens, there's judgments. Definitely focus on tax liens too. We're looking at past due real estate tax liens, things that can take over priority with your lien that we want to be sensitive to because that affects our collectability and affects those non-accrual elements we were looking at just a moment ago. Is their borrowing base out of status? Have they overexpanded, especially if their income and their expense items are out of whack? Do pay attention, of course, to that variable and that factor to make sure that they are in line with where they need to be for their operations. There's a business justification for that expansion, especially if they're using, operating funds to do that, and they're not supposed to be using those operating funds for that purpose. Maybe they're supposed to be using it for feed or to have inputs back into their operation. Instead, they're putting it into facility expansion, which we all know in a downturn in economy is going to have pennies on the dollar in terms of valuations. And of course, if their communication methods have changed, all of those could be indicative. The additional signs of distress we've included here kind of to serve as a quasi-checklist for those of you who don't have a good checklist you work from. The last couple of slides in this one definitely can help you, finish out or make sure your checklist is complete in these respects. Do we have, obviously, they can't pay down their operating line. Their payment history has changed. Are they borrowing from others to pay us? Do they have unpaid real estate taxes? And we've talked about those, but income taxes as well. Has their tax filing status and payment abilities changed in any respect? Have they increased their unsecured credit? So oftentimes we've looked at the real estate taxes, we've checked out other filings, we've looked at the financial information we've had, we've done a drive-by, we've done all these things, but if we can properly or appropriately pull a credit report or get an updated credit view, and we notice that their unsecured debt has changed from how it was the last time we did a review or a certain period of time, that's something else obviously to be incredibly mindful of and can help support some of those elements of distress. We've talked about some of the external forces, disasters being some of those, weather events, but also borrowing from retirement funds. All just, again, these help populate a checklist. But if you don't have one that you utilize, these are some of those stop sign moments, as I call them, moments when things change that we need to understand why they change and document that we've analyzed them. So when we become aware of a loan that has become distressed, obviously the documentation aspects we've been talking about are really key, not only to make sure we've got it documented correctly, but I literally will write down those elements of distress and write down examples next to every single element, whether it satisfies it or not. Say, no, it doesn't satisfy it, and here's why, or yes, it does, and here's some examples of why we've come to being that element is present and why it is or is not a distressed loan. But once you've documented that, hopefully in your loan narrative, in your credit write-up, whatever you use internally to track your documentation of the credit, I think it really helps a lot of ways to use that same insert, as I'll call it, into your notices and communications appropriately worded, to vary them up from the credit narrative now to an external communication to a borrower. It's really helpful. Is it keeps the mindset, it keeps your checklist correct, it keeps the communication consistent, which is what a borrower in these times needs and what a lender in these times needs to make sure we don't miss anything. And that becomes a checklist for not only our communications, but how we analyze any request we might receive. When I've mentioned earlier that we might want to get some additional data to analyze some of those elements, I've included here some of the things that I have found helpful or that I've worked with other lenders in gathering or observed them gather that I think is helpful to give us a complete picture. Getting that appropriate financials, requesting additional financials if we need them, looking at those property taxes, reviewing UCC filings to see if other creditors are right there, if other liens have popped up or security interests, if they changed the name under which they've made filings. All of those things can be really important. And also on the real estate side, pulling up a nothing further certificate or an updated kind of lien search to make sure we know whether their liens are implicating our collateral. If we don't have enough information after all of the things that we just mentioned on the prior slides, and let's say we may not have perfect communication, I do think sending a good notice or request or communication to the borrower is appropriate, requesting that assembly and inspection to make sure your collateral is still there. Does it look good? Is it being deferred? Or is it being properly maintained? Making sure we look at the payment schedules and that source that we were talking about earlier, and definitely making sure the insurance remains the way it needs to. So that's kind of the background, the longest section that I'll be covering in these first three. That kind of gives us a background in that distressed loan and some identification tips and checklist items to consider and some reasons why the timeline makes sense. But let's say when you've identified a loan as distressed, what do I think in my experience has been some good successful next steps? Communication is definitely key. And there's at least two camps of borrowers that we see in these opportunities. One is the communicative borrower, the one you can reach by telephone. You can say, look, we're looking at some changes, what's going on, and you kind of talk through what's going on, say, look, and you've already done your loan write-up, you've got your elements identified, you know what you're going to tell them, say, look, on our side, we've kind of determined that the loan qualifies as a distress loan, which is an accounting classification or an underwriting classification. We're going to be looking at that. We're going to send you a notice. We want you to look at that notice, and then let's sit down and have an opportunity once you've looked at your picture, gather some financial information we've identified for you, and let's see if we can get an application for restructure that you feel comfortable with, that you want to submit, or that we can propose to you. And let's make sure that we can see if we can get this loan in a different and performing status. Very helpful to have that telephone call if you can, or that in-person meeting, non-COVID times, if you can, to make sure that you've had that communication to let them know when they get that piece of paper in the mail or if you hand deliver it, what that means, and they don't just misconstrue it as a notice of default or a payment reminder, because it really is different. If we aren't able to reach those borrowers, this is that second camp of borrowers. You have one that will communicate with you, and now the second camp is they don't effectively communicate, or they are just stonewalling you because maybe they don't want to talk to you about what's going on. They're scared to have that conversation, whatever the reason is. or it's a 30-year mortgage set and go loan and you don't ever get financials, so communication is very infrequent for all the reasons we might suspect. But whatever it is, if you don't have an opportunity, don't delay getting the appropriate communication out to them. Do make a good faith effort. Do leave an appropriate communication with them by voicemail or whatever it is under your internal procedures. Then send out that notice as quickly as you can, and have that notice always pre-populated before you call. But then send that notice out and encourage them to come by and meet with you, or call you so you can have a good discussion about where you are. Now, we've talked a little bit about communicating with the borrower and reaching out to them. Let me focus just briefly on the kinds of notices. So depending upon your regulations and the industry that you're in, your notice requirements can vary. But some of the requirements, I think, in terms of a written notice will include, in my experience, obviously why you've identified the loan as distress, what reasons you think, and this is my experience on practical tips that are helpful, some examples of why you think the loan is distressed, the deadline that they have, if any, to apply to restructure the loan with you, what information they need to submit, such as certain financial information, a formal application if you have one, an updated balance sheet, whatever it is. Tell them when to give that information to you so you can analyze it, and of course the deadline for responding, like I mentioned. Sometimes certain regulations require you to identify if you don't restructure within the time period, if we aren't able to get a restructure in place. The alternative could be foreclosure to the extent permitted by law. And so there are certain requirements sometimes for regulations on how you communicate that, but making sure you satisfy that's important. I think it's helpful to include the criteria for measuring performance, meaning if you are able to restructure, how will you measure that? And I think it's important to have that in the notice so you have a good, transparent communication. And if there's anything else that they need to be satisfying in the meantime, communicating that sooner rather than later is really important. If a borrower is in bankruptcy, that could be one of those other stop sign moments that they filed for bankruptcy relief. Maybe it was out of the blue, maybe it wasn't. But that's another opportunity to analyze, is the loan distressed? And I will plug that I've had borrowers who filed for bankruptcy, anticipated or not, who didn't technically meet the definition because they may have filed for bankruptcy relating to one particular creditor, but on our side of the balance sheet, given our collateralization, given their performance with us, et cetera, they did not meet the definition. It was a watch and go moment that we documented and maintained. But even then, if we are able to, under our regulations or law, send a notice regarding the distress nature of the loan, we do that in accordance with the law, and of course, send copies to counsel if they have bankruptcy counsel. So definitely we always want to take these opportunities when we have stop sign moments, when we have moments where we have signals that something is going on for us to analyze. I always think it's a good opportunity to analyze your loan documents. Are they in good order? Do we have all the signatures we need? Do we have all the acknowledgments that may be legally required? How's our lien position, the UCCs, the nothing furthers that I mentioned earlier we could pull? Are we in good shape to move forward and pursue any rights or remedies if we have to go down that road, knowing that that's not, option one? We just want to make sure we've got everything taken into account. If we aren't in good shape, then what do we need to do to get in shape? That's what we're going to be focusing on as the next step. So kind of with that, we thought we'd kind of come to our first poll question, which is, in the last 6 months, have you at your shop seen an increase, decrease, or normal levels of distressed agricultural loans? One of the options is increase, decrease, normal levels are not applicable, your company is not involved in agricultural loans. I'll take a moment to let y'all to respond to that. Let's see what we got. So mostly we're looking at normal levels right now of distress. And so some for shops that vary. Sometimes some people have less than 1% of distressed loans, and that could mean lots of different things about the risk levels in your portfolio. And for other folks, it's somewhere between 1 to 5%, depending upon the levels of risk and maybe their portfolio, what makes up that portfolio at their shop. So that's a pretty good indicator. I think that's about what I would expect to see. So the third of my 3 sections that I'll be covering up front is basically once you've identified a loan as distressed in accordance with the elements applicable to your borrower, what are some options that we have found that have worked in these moments? So for me, obviously, follow your internal guidance, follow the regulations. We're always going to pull those out depending upon who my client is or what the relationship looks like. But for a restructure is kind of the goal. And so a restructure for us is Reamortizations, it can be a renewal, it can be a deferral of principal or interest, can be a monetary concession, or the taking of some other action to modify the terms of or forbear on a loan. To me, it's basically any action appropriate given the credit and given the operation and given the collateralization, for example, of that loan. Whatever's appropriate that can help get that loan, returned to viability. And so that can take a number of things. What it isn't, to me, is a full liquidation or an expectation that the loan will be paid off within 3 to 6 months due to disposition of assets, some third-party loan, refinance, whatever. Those aren't restructures. Why? Because they're not they're not steps taken to return that loan to viability to a performing status, and they don't contemplate a continuation of the lending relationship with that particular borrower. So because this is where I get a lot of questions whenever we do restructures of can it include a forbearance? And yes, it can include a forbearance in my experience, and it can also include a partial liquidation if it helps make sure that that loan is in a better status. Sometimes there's just too much in terms of expense items driven by how many assets there are to maintain. And sometimes we need a little bit of breathing room so they can catch up, or to allow for disposition of an asset or collateral, or to allow for a market sale, something to happen to get the cash flow back on the operation, and maybe we do a forbearance. But for me, in those moments, that forbearance should not be just to sit back and wait and watch, unless for whatever reason your cost analysis and your analysis on that application for restructure makes sense. It really should be an opportunity where they're doing something during that period of time that will lead to a better relationship and a better performance of that loan and that loan contract. If the borrower does timely request a restructure, or if you propose one, there are some criteria that you probably should make sure you follow. Definitely want to follow your internal guidance that's appropriately written, your regulations that can apply. In my experience, we're looking at things about the cost to the lender of the application for restructure. Is that cost less than or equal to the cost of foreclosure, considering all those relevant criteria? That's generally what we're going to be looking at. I wanted to include these elements spelled out in particular. These are very common in looking at several different industries of lending. These are very common elements, and they're common for a particular reason. I mentioned earlier that there's a relationship between distressed loans, between non-accrual debts and reinstatement. Some of these factors that you're seeing here on this slide and the next couple of slides are all indicative of elements you might also see in a non-accrual classification or in a reinstatement factor. So it's all very consistent across the board in the kinds of elements and factors, and it makes sense. Whatever you saw that was lacking that led to a distress, that led to a possibility for restructure, will also be some of those elements that you'll analyze to return it to viability or to reinstate that loan to an accrual debt or accruing debt. So all of these make sense, and that's why the documentation should be consistent and across the board. So I won't stop and read these for you, but do analyze those factors. Do make sure you have a really good checklist, and do make sure you document all of the applicable elements for restructuring the loans and the costs that you need to consider to see whether or not that particular restructure application or opportunity makes sense given the credit where it is. Some of these things is the borrower contributing basically all the income over and above necessary and reasonable living operating expenses? Do they have that financial capacity and management skills to protect the collateral from diversion, dissipation, or deterioration? That management skills is really important. As many of you might know, on the reinstatement side and on the non-accrual determination, that subjective component is willingness of management. And so go back when I said earlier about having those communications with the borrower at the outset, if you can, that willingness to cooperate in the process is part of that subjective component that 5 C's of credit to that can flow through all the way on restructure analysis as well as reinstatement analysis. So I've included here too, for your convenience and just to round out the analysis, the analyzing the cost of foreclosure. And these are some of those elements that I commonly see. I've taken these from the 12 CFR 617 series that are applicable to farm credit, but they're also borrowed, like I said, from other industries as well, very consistent across the board because they also match a consistent FFIEC and other guidance on non-accrual debt determinations and reinstatement factors. So these are some of the factors that you should be documenting on analyzing that cost of foreclosure so you can make sure you're making good, sound financial sense and good credit underwriting determinations in connection with analyzing these things. If the potential cost to the lender of restructuring the loan is less than or equal to the cost of foreclosure, that dictates the determination. If there are multiple opportunities for restructure, then go with that one that presents the least cost and has the best likelihood of returning the loan to a viable status. at the end of it, whatever you decide to do, make sure it makes sense, takes in all costs and factors to make sure you're doing the best by your lending institution you can, to make sure you're accountable to your lending institution, and also making sure you're helping the borrower the best way you can from a sound lending principles perspective to get that loan to a performing status. I've mentioned here about the reinstatement a few different times. I've included here why that's important, of course, and what some of those reinstatement factors are, just to show the parallels between this and the distressed loan determinations. So we definitely, when you have your materials, do go back and compare those to some of the own that you may have at your shop. And if you don't have these spelled out, make sure you are familiar with those, because that will help obviously dictate when a loan has been properly classified as non-accrual, is eligible for reinstatement, and making sure that whatever agreements and restructure opportunities you have in place help get them back to a performing status, which should be the goal. Having said that, I will definitely highlight not all loans are capable or suitable for restructuring. Sometimes they're too far gone. Sometimes there's not much to work with. And at that moment, I'm going to borrow a phrase, and I don't mean it legally, I just mean it practically. Do what's in the least cost of the windup and the exit of that relationship that makes sense for your lending institution and complies with your current standards. So with that, I've kind of set the stage for the restructures, the distressed loan determinations, deteriorations, and non-accrual debts. And we'll kind of turn it over to the second half of the presentation that talks about some of the additional considerations that lenders have. Michael?
Thanks, Stephanie. All right, so I want to try to build on what Stephanie has done, and I want to try to do it in a way that creates an easy-to-remember, practical framework for dealing with distressed debt. And to kind of couch this, a few months ago, I had this idea really hit me as I was thinking about how do you really deal with distressed loans? How can we make better decisions? I had heard of a study, I'd heard of a study where they looked at major corporate decisions over like a 5-year period of time, and they were looking at, well, do you get better decisions when you're just looking at data analytics or when you have a sound decision-making process? And the study, this was out of a McKinsey consulting report, they found that the decision-making process mattered more by a factor of 6, which is really astounding when you think about it, because everybody would think, well, if I've got good analytics, I should get good answers. And the problem is, what the McKinsey report said, is that if you everybody does the data analytics, but a lot of times if you don't have a good, sound decision-making process, you'll essentially have blind spots where everybody on your team thinks this is the right answer, and you go down a path only to find out that there was something you didn't consider, and so it turns out to be a bad decision. And so the key thing, of the McKinsey report was that you need both a good decision-making process and obviously you need good data analytics. And so as I was thinking through that, it occurred to me that in the life of a loan, you get to what I call hinge points. And we're going to talk about that because it's, at least for me, it's an easy to remember way to approach these loans. Now, the key thing here on a hinge point is this is not, some easy magical sauce that's going to make all your hard problems become easy. It's far from that. What it does, though, is it creates a methodology or a framework to help you think through the loan and how to try to maximize the recovery for the lender, both in the short term and long term. And so what we have here, you see the definition up on the screen. The hinge point is its event. It occurs over a relatively short period of time, but it's going to have a major impact on the collection of the loan. The problem is these hinge points can happen in the midst of a flurry of additional activity, and the key thing is discerning what is what. The other point is hinge points are not fixed in time. They can be movable. They're really more situational or circumstantial. But the key thing is they do occur, and you want to recognize them. Now, somebody may say, well, is leverage a hinge point? Because leverage is super important. Well, yes, leverage is super important, but no, leverage is not a hinge point, right? Leverage, personal guarantee, the threat of a default of a loan. What leverage does is leverage aligns the incentive of the borrower with the lender. That's what we use leverage for, and I'm using leverage in that sense, not in the debt sense. The flip side is lenders will influence, but they don't control the hinge points. And so somebody would say, well, why should you focus on the hinge points? As you'll see here at the top of the screen, it's akin to focusing on the 80-20 rule. You know, we want to focus on those key events that are going to have kind of an outsized outcome for the lender. And so now that I've hopefully baited you enough, let's talk about the hinge points. We're going to first put this in a screen. Actually, we'll come back to this screen. Let me just jump ahead. You can see the screen right here. We've got the 7 hinge points. Let's see what they are, and then I'm going to go back to the graph. You have underwriting and documenting the loan are the first 2 hinges. The third one is the early exit. The fourth one is the forbearance period. The fifth one is where you're pursuing your default remedies. The sixth one is after a bankruptcy has been filed and you're contemplating whether or not you do bankruptcy financing of some sort. And then the last one is the plan confirmation. So now let's go back to this graph to help you just visualize and see why this is important. So we have here, if you look at the graph, on the y-axis, we have kind of the long-term loan viability. And so you've got a loan that's, from a long-term perspective, a market-based perspective, it's not viable. If you're below that gray line, if you're above the gray line, it's going to be a viable loan. And you can see that as time progresses, the red line is showing a deteriorating loan. The quality of the loan is deteriorating, could be for a variety of reasons, but the loan is going down. You then see those 7 hinge points, right? And if you note, particularly at hinges 3, 4, 6, and 7, I have green lines going up. And the green line is supposed to represent this idea or this concept that if we get to this key critical juncture, and if we do it right, we may actually change the trajectory of that loan, right? So it may have been headed on a downhill basis, but the steps that we take, if they are taken, if the right decision is made, and obviously this requires cooperation and some participation by the borrower, that can change the trajectory of the loan. And so if you can identify when that hinge point is occurring, and then you can act on it, that's going to make a major difference for you. And now you'll see that I have going across here the refinance zone. And you'll see, like on hinges 1 and 2, right? That's where you're doing your underwriting, and then that's why you're documenting the loan. Underwriting is critical because you're trying to decide, do I get into this mess of a situation to begin with? Hinge number 2 is documenting the loan, and obviously if you mess up in how you document your loan, that's going to have some major adverse impact once the loan goes into distress. That's why I do put it a hinge, but it's a very short moment. But then you get to hinge number 3, which is the early exit. So let's jump ahead because I want to talk about that because hinge number 3, the early exit, is by far and away the most important hinge point that's out there. And let me just briefly describe it with a quick story here. There's a couple of well-known national companies in the ag industry that I've represented for several years. They both sell the same product. One thing that I noticed over the years is that, they would typically deal with the same customers, and then the customer would go into bankruptcy, and so then each of the respective clients would have a deficiency or being sued for a preferential transfer. And the one thing, though, that I noticed over the years was the one company consistently had larger losses, and the other company consistently had smaller losses. And so one day, I was talking to the credit manager there, and I said, I've just noticed that when these cases happen, you tend to not have that big of a loss. And I said, what are you doing? What is it? And his response was essentially, I don't know, but I can just tell when I need to get out of a credit. And it dawned on me that, whatever his senses are, his business acumen, whatever it may be, he recognized when a company, a client was going downhill and it was time to get out. And that, I think, if I had the secret sauce for that, if I could tell you when you as a lender need to get out of the loan, I'm sure I'd be making a whole lot more money than I do here as an attorney. But that is the key. That is kind of the holy grail, identifying when this loan is heading downhill, but it's still above that refinance zone that we mentioned, which means that there is still a market where some other lender is going to go out there and take that loan out. And that is the key. And I realize that what I'm saying right here is really, this is not so much a legal perspective. This is a situation where internally the bank needs to be properly evaluating the data, analyzing it, having a sound decision methodology, and then acting in a way that they can gently push the borrower to get out. Now, here's the key thing. Maybe you are being approached, right? Somebody's contacting your institution and saying, hey, I'd like to come work with you. Well, I think the immediate question that you need to be asking yourself is, okay, where do we stand in the perspective of the 7 hinges, right? Because if they have been working with a prior lender and that prior lender is essentially saying, you know, gee, it's been great working with you, we want you to take your business somewhere else, right? That to me is going to be a red flag. What is the other prior lender seeing that you are not seeing? And then you get into kind of all sorts of data analytics. And, you know, if you want to take a baseball analogy, you look particularly at like the Oakland A's for anybody that, you know, follows sabermetrics. The Oakland A's, they got into the statistics and they started identifying kind of these baseball players that the market didn't perceive as valuable, but they, you know, they were really good in certain areas, and Oakland A's have done pretty well over the years with their sabermetrics approach. It really revolutionized baseball. It's the same type of concept here of, you know, sometimes we as lenders think we can outsmart other lenders, but we need to be really careful about that and make sure we're not making a mistake when we get into this. So how do you do that? Well, I don't need to repeat all the, you know, the different hard data that you're going to look at, right? You've got your liquidity ratios, your efficiency ratios, solvency ratios, profitability. These are all well-known metrics that you're using for evaluating the loans. You also have your soft data, and Stephanie has certainly mentioned several of those factors in her earlier slides. And as you'll see there, I think the soft data really becomes the leading indicator for the hard data. And what do you mean by that, you ask? So you'll see here on the chart, this is another way I've at least conceptually thought of how do you evaluate the data and really try to figure out where this loan is trending. And I borrowed, you know, from the Department of Homeland Security. They have their terror threat level system with the green, blue, yellow, orange, and red levels. I think if you follow the similar approach, you list your data, right? And some data points are going to be a lot more important, and that's kind of indicative by the bigger circles. Some data points, they're interesting, but they're, you know, from a consequential standpoint, they may be smaller. You rank those hard data points. And then you want to go in and rank the soft data points, and then you essentially want to draw a line. All right, where is this loan going? And the reason I like this approach is because it is applying a methodology to help you more properly analyze a situation and try to add some objectivity to this flurry of, you know, different, somewhat unrelated information that's coming at you as you're trying to make the really hard decision, which is, what do we do with this loan? And so again, you know, another table right here, you can see the same thing. Theoretically, you may have somebody that's maybe not doing that well from a hard data perspective. Certainly, you know, from 2019, everything that happened with the trade wars, 2020, COVID, you may have somebody that's really hurting financially, but maybe they're doing a lot of the things right. Maybe the soft data is really trending upwards. Well, that may really influence what you do as far as working things out. Now, we covered the forbearance. Won't go into this in any detail. The one key thing on forbearance, like Stephanie said, that is the longer a loan lingers in some sort of default stage, our experience is that the less likely you are to turn it back to something performing. And so the key on forbearance is you need to know when to pull that trigger and get working in a more meaningful manner. And I realize that's hard because sometimes you got the loan officer on the one hand who says, you know, who just essentially wants to have a soft discussion, so to speak. And it's another thing to then raise it, elevate it to where you're sending out some sort of formal notice and really trying to put a more formalized structure of a forbearance in place. But again, I mean, I think, and I hope I don't offend anybody by this analogy, but the idea of a cancerous tumor, I think, is a really good analogy. If the tumor is small, if you spot it soon, if you address it quickly, the odds of survival are much higher. But if you ignore the problems, if you don't get it checked out like you need to do, the odds of survival are certainly less. And that is very true when it comes to a distressed loan. I've got up there on the screen some keys to successful forbearance. Obviously, the key thing is you want to make sure it's crystal clear, have clean, hard dates when key milestones have to be made. The default remedies, the one thing that's challenging with pursuing your default remedies is that at the end of the day, a lot of this is out of your control because you are beholden to a court acting. That's certainly true in some instances, but there are things that the lender can do. And as you are contemplating your remedies, it is critical that you start mapping out kind of on a timeline, how long do you think it will take to do this? What sort of resistance will we get? And what will be the market conditions, assuming our timeline roughly holds up? And that is really critical when you get into ag-related items, which are so seasonal, because, for example, the timing of when you foreclose on real estate may impact the value, whether or not somebody can get the crop in, planted on it, a prospective buyer, or whether or not you missed the year because you liquidated the real estate too late, so somebody kind of loses the opportunity to grow a crop on it. Anyway, the key critical issues. I know we only have about 10 more minutes, so we'll pick up the speed here. Bankruptcy financing, all right? This is when somebody's filed. I know we hate it. We don't like it. What do you do with it? I wrote, when I was dealing with the Hinges, I recently submitted it was about a 44-page academic article that I've submitted for publication, where I went and pulled a lot of academic research dealing with distressed loans and tried to apply it in this Hinge context to come up with a good framework. And one thing that really jumps out from the academic research is that when you have a borrower that gets debtor in possession financing, they are more likely to successfully emerge from bankruptcy. And if the entity that is doing the debtor in possession financing is the pre-petition lender, then the duration of the bankruptcy tends to be shorter as well. And I've had many clients over the years kind of wring their hands in frustration with the bankruptcy. I get it. It's real. It's frustrating. But if you're looking to how do we kind of compress that, how do we shorten that, the debtor in possession financing statistically makes a big difference. Now, obviously, you're not going to do that if the borrower can't cash flow. If you don't trust them, that's another big issue. But that is a key point to think about. Finally, you get plan confirmation. You really need to think through the plan because that's going to control your dynamics, your framework going forward. Moving on here, we've got the next poll question that we need to do. So looking ahead to 2021, do you anticipate the number of distressed agricultural loans that your company faces will decrease, remain flat, or increase? So if you can just go ahead and quickly submit your answers, we will carry on here. And we're getting pretty uniform response right now, remain flat to increasing. So those are somewhat similar to what we were seeing previously. Let's get on to the fifth section, key traits of lenders, borrowers, and others. Why is this so important? All right, and you say, why should I even be thinking about this? Well, the key thing is traits strongly influence incentives, and incentives really impact behavior. And so if you are trying to make a good decision on a distressed debt, you need to really be thinking, it's like a chess game. You need to be thinking, how am I going to act? How is my opponent going to react? And this is infinitely more complicated than a chess game because you have multiple people at the table. They're playing the same game, and the dynamics change as the market changes. The lender traits are listed up there. You obviously have a copy of the PowerPoint, so I don't need to hammer on that. The one key thing about lenders, which is not just indicative of lenders, but when you look at decisions generally, lenders are biased or they prefer liquidation over an uncertain future. You'd rather liquidate it, get the cash now, minimize my loss, as opposed to theoretically letting the borrower remain in possession and try to pay back the principal and interest over time. That's just human nature. We prefer the certain defined thing in the short term as opposed to the possible uncertain thing in the future that may be larger. That's a key point. Another key point of borrowers, let's move on to borrowers, is they are rational people. When you are dealing with distressed ag loans and small businesses, there is rarely a change in management. That is really critical. And the reason for that is because when you look at the academic literature, a lot of times if you got the same bad management that got you into the bad situation to begin with, the concern is that those bad traits carry over into the future. And that creates a unique situation where if you are going to really be having these discussions about really trying to turn the loan around, there has to be a change in the way the borrower, the manager, is approaching the business. And that creates a big area of focus. Another key trait of borrowers is their perceived equity in the collateral. And this makes a lot of sense intuitively, but if there is a lot of equity, they have a lot more to lose. The flip side is that if they have less equity, they have less to lose, and so they are more likely to default. There was an interesting study that came out of the New York, the Federal Reserve, out of the 2008 housing crisis, and it can be applied to ag loans, but it was done in the consumer context. And the ironic thing that they found is that as equity in the homes decreased, what happened was the likelihood of default increased, but at the same time, there was a decrease on credit card debt default. And you say, why is that? And what they realized is that borrowers, they got to keep on living, right? And they got to keep on, they will need somebody to survive in the future. So if they realize that you, the big lender, are kind of a foregone conclusion, they may just quit paying you altogether, but then they will focus on those creditors that they need to appease in the future to survive. And so as you're looking at the distressed loan and looking at who are they in default with, and as you're evaluating your situation, you need to take the big global perspective and try to figure out what are this borrower's incentives. If there's big equity, obviously they're going to be incentivized to try to save the property. The key thing too, I want to emphasize, is that especially with ag lands, generational ag lands, equity is not just dollars, debt, versus the value of the property. There is an emotional investment in the property. So you can have real estate that could be well underwater, but the borrower may, borrow from a retirement account or do whatever to pay that debt. Other thing I need to mention really quick about factors influencing bankruptcy. When you look at the academic literature, there are 3 items in particular that have a big impact on whether or not a borrower will file for bankruptcy: the debt level, the short-term cash, and their ability to coordinate with other creditors. And then there's these 2 other items that I've listed as well: the equity and the non-dischargeability of debts. If you think about this, this is like a formula, right? If you want to stave off bankruptcy, if you impact those 3 items, the debt level, the short-term cash, and the ability to coordinate with different creditors, that can either stave off the bankruptcy or it can actually hasten a bankruptcy as well. And sometimes that's where you get into the decision-making errors. Sometimes you say, well, we're going to go out, we're going to just blitz them, we're going to set off everything. Well, suddenly they don't have cash, so what does the borrower do? They file bankruptcy, right? You've accelerated that. So you want to think through the incentives. Bankruptcy courts, interesting thing there, the code is structurally biased to favor debtors. We want to try to avoid that if possible. You get into attorney traits. I'll leave that for you to peruse as well, because we're coming right up on the top of the hour. Some key actions to getting better results. I've listed them out there. The key thing I need to mention, just from a practical perspective, in addition to what is on the screen, when you are looking at when you're at farm renewal season, it's really critical, A, that you look at your federal government payments. Have they been documented and assigned to you? We see that with CFAP 2 monies. We saw that last year with the Market Facilitation Program payments. Is your borrower signing the necessary paperwork so that the cash is coming to you as the lender? That's a key critical item you want to check. Another key thing, When you're looking at like crop insurance proceeds, this would also be true for government payments. Are you perfected at each step? Have you filed your UCC filing? Are you named as a lien holder like on the crop insurance or on the government payments? The reason for that is you've got to get that assignment, and the crop insurance is not going to send the money to you unless you're listed there. If the borrower's banking at some other account or bank, do you have a deposit account control agreement? You want to be perfected at each step along the path of the collateral, and as you're analyzing the situation, you should ask yourself, am I doing that? Another key issue, Food Security Act, right? Most of the states here in the Midwest don't have a centralized filing system. Nebraska is the one exception to that. Those notices only work for 1 year. So are you sending out those notices each year to the grain elevators, to the sale barns to protect yourself? Another key issue, who actually owns the equipment or the cattle? I think we've all had our anecdotal situations where we've been there, where they represent one thing and then it goes to foreclose and they say, well, my dad owns that or so-and-so owns that. All right, you want to document that, figure that out up front. Other key issues, look at your loans, how well they're documented. Do you have landlord issues? Do you need to get any sort of subordination agreement in place? Also, the final thing is UCCs, right? If somebody filed the UCC and is paid off but doesn't release the UCC, if they then go back to that earlier lender and get a loan, they can suddenly prime you. So you want to make sure that it's all cleaned up so nobody inadvertently primes you. We are at the top of the hour. We need to do the one final question and we'll end this. For agricultural borrowers that want to refinance, do you anticipate that it will be easier, more difficult, or about the same to do so as in years past? You can see the answers right there. Go ahead and submit it. And whoops, click the wrong button. And I think I did it too quickly. So we do have one question, a couple questions that came in right now. And looks like Stephanie has answered them. So Stephanie, I think I've basically concluded everything. Do you have any final points that we need to discuss?
No, I think that's a really good summary, and I know it's a lot of content in an hour, but hopefully it gives a nice summary and creates a little bit of a checklist for some of you, either to say, yes, you're doing these things already, or if not, maybe add some of these things to your checklist. But for me, Michael, and I'm sure you too in your experience, early identification and early action and no delay is probably the key to success in most of these things. If you can restructure it, those things are likely going to help you do it.
Yep. Well, guys, everyone, I shouldn't say guys, that's sexist. Ladies and gentlemen, thank you for joining us today. We hope the information that we've presented to you has been helpful. Just as a few housekeeping reminders, this program has been approved for legal education hours. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. And this concludes our webinar. Thank you.